It's a complicated market right now. We're dealing with a number of issues globally, and there's a lot of uncertainty. And so clients are trying to manage their balance sheets, trying to manage their forecasts through that time. I do think we are expecting there to be some capital raising come in. There are companies that need to raise capital over the coming weeks and months. But as far as the IPO market, I think what we've seen in the performance, and you were just talking about it, some of the aftermarket performance hasn't been as strong as folks had expected or anticipated. And so in reality, we're probably waiting until 2024 until we start to see a bigger pipeline of newly issued public IPOs.
So does that mean 2024 is going to be a better year than 2023 for IPOs?
That's certainly what we're hoping at this point. I mean, it's been a...
What if we fall into a recession? Does it still look like it could be a good year for IPOs?
There are a lot of companies lining up, and a lot of them have secular growth as opposed to being exposed to cyclical aspects in their business. The one thing that we have seen, and we're tracking, over 1,000 companies private companies right now, and there's a lot of really interesting, really exciting companies. The real question is, when is the right time for them to go public? When are they going to get the reception, both at the IPO, but importantly, are they going to see the aftermarket performance? And that's been the biggest struggle of the recent vintage.
Some of the deals that came public, Doug, after Labor Day had what they call marquee investors. Or I'm not sure what the term is. I never had them in my deals. Whatever that top allocation was, I gave Fidelity twice that amount, and I'm done. What are these marquee investors, and how's that come into it? And is that important?
Yeah, we refer to them today as kind of cornerstone or anchor investors.
Yep, that's the term.
And part of it is in a market that's reopening, like we're going through. Part of it is, how do I de-risk a transaction? Okay. And so those investors act in two things. One is they take some of the potential supply. And the second thing that they do is provide a validation for investors and give them confidence. A broader group of investors that people have done more work, they've met the company privately early on, and they're willing to go on the cover of a prospectus. And so that provides greater validation in the market.
So what's the, where are we in terms of the private equity business and the private credit business? Because it seems like companies can stay private a lot longer. There's so many sources of capital for them. They don't need maybe to go public as much as maybe they did prior. Where are we in that continuum these days?
Yeah. And so at Citi, we run our public and private capital raising all through our group in equity capital markets. And we are seeing that convergence, right? And so investors or companies are thinking about, where do I raise capital? What are the alternatives in the private market? What are the alternatives in the public market? And how do I think about that? And you're right, there are more alternatives today in the private market, but that's not a perfect market today either, as we've seen. I think that the real question for companies is there strategic value in being public? And what's the value? It helps in retention of employees. It helps that it's an acquisition currency. And for many companies, it helps from a branding event for them. And so there are different reasons to go public than just raising the capital at the time of the IPO.
I mean, how much have you, when you're looking at your employees, right, in your group, have you seen a shift from the amount of women and men you hire to take companies public and the amount of women and men you hire to give them money on the private side? I mean, you've been at Citi since like Nirvana, right? Mm-hmm. So
yeah,
the band. Okay, you've been at Citi since the early '90s, right?
I have. In terms of where people are spending their time, we've asked our team to really focus on understanding what companies' needs are, and then thinking about both public market solutions as well as private market solution. And so the teams are versatile to be able to talk to clients about the different alternatives that exist. And that's one of the things that we've been really focused on, is understanding the client and coming up with solutions that best fit their needs.
On the private, I know source of IPOs across the street of private equity finance companies, and you always are talking to your private equity clients about kind of what their needs are. There haven't been a lot of IPO activity for several years now. I would think the backlog from the big private equity companies are like, guys, you give me a 5-minute window, I got to get some stuff out the door because I need some monetizations. I need to mark these things. I need some gains to show my LPs. Where is the backlog, out there on the street these days?
I think there's no question private equity firms are evaluating their portfolio companies and trying to decide which are the right ones to exit in the public market and which are the right companies to exit in the private market. And they do that all the time.
Yep.
I think with a better functioning leveraged finance market, one of the things that has happened is the notion of a dual track process has become back in viable alternatives for companies versus just having one alternative. Having multiple alternatives always help those sponsors. But you're right, they are under a lot of pressure to return capital to their LPs as they look to raise the next fund.
Exactly. So what's it used to be back in the day, my day, we could take a company public with just a thought, an idea. Now you have to have revenue. You have to have profits. You have to have defendable franchises. It seems tougher and tougher. Where's the market now in terms of if I wanted to bring my company public, what would you tell me I'd have to have?
We focus on companies that are either profitable or a clear path to profitability in the near term. And that's what investors want. When we're in a market that's reopening, you have to really open the market with the highest quality companies. Rebuild the confidence that's been challenged over the last 24 months. One of the things going back to 2021, prior to 2021 or 2020, there was an argument that companies were staying private too long.
Yep.
And in 2021, everyone said companies are going public too early. And so finding that right balance, especially in a market that's recovering, it's not a straight line. And so starting with the strongest companies, rebuilding that confidence in the public markets, and then giving options to companies in terms of when and how and how large to raise capital becomes important.
Are there any sectors out there that you're seeing more or less demand from your clients? Hey, we want more energy, or we want more tech, or what are you hearing from your clients?
The clients are focused on growth.
Yeah.
And quality of company. So I don't think it's necessarily
those two things didn't used to be the same thing, right? Growth and quality. And when you say quality, you mean like free cash flow, right?
Or profitability or path to profitability. People that have built a moat around their businesses and are differentiated. There's a lot of companies working on really interesting, as I mentioned earlier, strategies and disrupting traditional industries. But the real question is, have they proven that they can actually operate as a business as opposed to a plan in those areas? But we're seeing companies certainly in the software space, in technology more broadly. We're seeing companies in the consumer space. Healthcare has been one of the most active spaces in the capital markets. But we're also seeing companies in financial services, real estate, and others trying to figure out when will be the right time to access the public market.
Are hedge funds, where are the hedge funds in terms of buyers of IPOs or just new issues? How important are they to an underwriter like Citi?
Yeah. Look, all the investors, the active equity investors are important. So long-only accounts, the mutual funds, hedge funds, all make up kind of the complexion of the investor base. And one of the things is we look at the IPOs that came post-Labor Day, it wasn't a demand issue.
Yeah.
Right? Those transactions were multiple times oversubscribed. The challenge has been the aftermarket performance. And part of that is, and regardless of whether you're a hedge fund or a long-only investor, the average or the typical active equity investor are trailing their indexes because the indexes have been dominated by a small number of stocks. And so if the stock isn't performing well, they can't chase that in the aftermarket. They have to cut their losses rather than suffer.
Because I kept wondering, because I said, back in my day, I'd know where you're buying here, how much you're buying. So if the stock does fall, I know you're coming in to buy more. But it seems like we didn't see that this.
Yeah, I think there's some technical factors and some fundamental factors. I think the technical factors is the underperformance by the active equity investor relative to their benchmark. And the fundamental challenge has been, the 10-year has moved pretty significantly since Labor Day. So the cost of capital for these companies has gone up significantly.